If you've been watching the metals market even casually, you probably felt it. Silver didn't just fall, it collapsed. 34%. Gone. In a single session. That kind of move doesn't whisper, it screams. And right now, as you're watching this, we're heading into a trading day that could decide the tone for months, maybe longer. February 2 isn't just another candle on a chart. It's a stress test. Stay with me, because I'm going to show you why the next few hours of price action could tell you whether this was a liquidation crash or the reset before the next major run. If you're holding silver right now, if you've been watching this market, if you're trying to understand what just happened, you're in the right place. Because what I'm about to explain isn't just about silver, it's about how markets actually break. Before I explain what caused this, let me teach you something most people don't understand about markets. Prices don't usually break because investors calmly change their minds. They break because leverage snaps. Think of it like this. Imagine a crowded theater where someone suddenly yells fire. The exits don't get smaller, the crowd just panics at once. Everyone's pushing for the same door at the same time. In markets, leverage is that crowd. Borrowed money amplifies your gains on the way up. Feels amazing when it works. But on the way down, it becomes forced selling. Brokers don't ask politely. They don't negotiate. They liquidate you. And when enough positions get liquidated simultaneously, price stops reflecting value and starts reflecting urgency. It's not about what silver's worth anymore. It's about who needs to sell right now, today, this hour, to meet a margin call. That's the difference between an orderly sell-off and what we just witnessed. One's a choice. The other's a gun to your head. So what does that tell us? It tells us that after a massive flush like this, the very next session often reveals whether the panic is ending or accelerating. That's why tomorrow matters so much. Now here's what's actually happening under the surface. The primary driver appears to be margin liquidation clustered around that $75 to $80 range. That zone, right there, that's where leveraged longs had built enormous exposure. We're talking massive positions, stacked on borrowed capital, all betting on continuation higher. Once price sliced into that pocket, everything went mechanical. Algorithms triggered stops. Brokers issued margin calls. Funds began selling whatever they could, not just what they wanted. That's the cascade. Price falls, collateral shrinks, positions get closed, price falls more. It feeds on itself. And here's the thing. When you're in a margin call, you don't get to be selective. You sell your winners to cover your losers. You dump liquid assets to save illiquid ones. Silver's liquid, so it got hit hard, fast, without mercy. The secondary confirmation you need to watch? Volume and open interest. If price stabilizes while both contract, that suggests sellers are running out of inventory. The market isn't being pushed anymore. It's simply digesting what already got dumped. Picture a wave that crashes on shore and then pulls back. The energy's spent, but if price keeps sliding while participation rises, that's new pressure entering the system. That's not exhaustion. That's acceleration. Different story entirely. And that's what separates a flush from a structural breakdown. One's temporary violence, the other's a repricing of reality. Here's what's wild about this. Markets often bottom not when news improves, but when selling physically exhausts itself. The last seller capitulates. There's no one left who wants out badly enough to accept these prices. That's when the bid comes back. Not because fundamentals changed overnight, but because the mechanical pressure that overwhelmed price discovery finally lifts. But here's the part that should make you nervous. Most traders focus on the price level when the real signal is behavior. Does silver stop reacting to bad news? Does it refuse to make new lows even when conditions suggest it should? That's how turning points form. Quietly, at first. Almost suspiciously calm after chaos. You'll see price attempt to break lower. Fail, try again, fail again. Each failure builds a base. Each rejection of lower prices tells you something shifted. Now let me show you what most people are missing. When leverage gets flushed, price discovery shifts back toward real demand. Industrial buyers don't care about margin calls. Long-term allocators, sovereign participants, they don't chase spikes. But they step in when volatility hands them opportunity. If they start absorbing supply tomorrow, you'll see it in tighter ranges and failed breakdowns. The market will feel different, less erratic, more anchored. That's not hope, that's observation. This is the exact same playbook that showed up in 1980 after silver's vertical crash. Remember that? Silver hit $50, then collapsed. Brutal, violent, fast. But once forced selling cleared, the market didn't instantly rocket higher. It stabilized first. It built a base, took time. Same rhythm in 2011. Silver ran to nearly 50 again, crashed hard, then spent months finding its footing before the next directional move. Different era, same mechanics. Zoom out and you see it. Violent unwinds often create the conditions for the next move up because weak hands exit and stronger balance sheets take control. The flippers leave, the accumulators arrive. Every time this has happened, the transition point looked deceptively boring compared to the chaos before it. That's actually the signal. When markets go from violent to dull, when volatility compresses after expansion, that's often where the setup forms. Not exciting in the moment, but profitable if you recognize it. And here's another parallel. In 2008, during the financial crisis, silver got hammered, dropped from near $21 to under $9 in months. Why? Not because industrial demand vanished, because funds needed liquidity and silver was the easiest thing to sell. Fast forward a couple years, silver hit nearly 50. The fundamental drivers were still there. They just got temporarily overwhelmed by technical liquidation. Sound familiar? Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this drop signal something structurally wrong? Possibly. Sometimes a crash isn't a reset, it's a repricing. Maybe industrial demand's softening more than we think. Maybe the macro environment's shifting in ways that genuinely hurt silver's outlook. Could tariffs impact demand? Yes. Could a stronger dollar pressure commodities broadly? Absolutely. And yes, you'll hear the usual manipulation narratives, spoofing, naked shorting, conspiracy theories. Here's the thing. I'm not saying none of that exists. I'm saying blaming shadowy forces doesn't help you position capital. It doesn't give you actionable insight. Focus on what you can actually observe. Liquidity, participation, reaction speed. Markets leave footprints. Your job is to read them, not argue with them. Whether someone manipulated this or not doesn't change how you respond to price action tomorrow. There are probably three types of people watching this right now. First, you might be the stunned holder thinking, do I cut this or ride it out? You watched your position get destroyed in a day. It hurts. I get it. Let me be honest with you. Emotional decisions after volatility are usually expensive. You sell the bottom, then watch it recover without you. Or you hold out of stubbornness and it keeps falling. Instead of reacting to yesterday, watch tomorrow. Watch how price behaves. Stability tells you something. Continued disorder tells you something else. If silver can hold ground without heavy volume, if it refuses to break lower on retests, that's information. Use it. Don't make decisions based on pain. Make them based on evidence. Second, maybe you're the opportunistic buyer scanning for discounts. You didn't own silver before, but now you're interested. 34% drops don't happen often. I understand the appeal, but here's my advice. Patience is a position too. Let the market prove that supply is drying up before stepping in front of momentum. You don't need to catch the absolute bottom. You need to catch the turn, and the turn shows itself through behavior, not price level. Wait for signs that selling's exhausted. Wait for failed breakdowns. You'll sacrifice a few percentage points, but you'll gain confirmation. That trade's often worth it. Third, you could just be the observer trying to get smarter about how these cycles work. You're not trading this, you're learning. Good. Because once you learn to recognize leverage flushes, you'll start seeing them everywhere. Crypto, equities, commodities. Different assets, same human behavior. Same mechanics, same patterns. Understanding this makes you a better investor across everything you touch. Here's the universal principle that applies to all of you. Markets don't bottom on hope. They bottom on exhaustion. They bottom when the last seller who absolutely has to get out finally does. When margin calls stop. When forced liquidation ends. That's the foundation for recovery. Not optimism. Exhaustion. So here's what I want you to answer in the comments. Which type are you? Are you holding and wondering what to do? Are you looking to buy? Or are you here to learn the pattern? Tell me where you stand, because I want to know who's watching and how you're thinking about this. So, here's where I stand. I'm not blindly bullish, and I'm definitely not chasing panic. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether silver can hold ground without heavy volume. If price stabilizes on light participation, that tells me selling pressure's fading. If it takes massive volume just to stay flat, that's different. That's an active battle. Second, I'm watching open interest. If open interest drops significantly while price stabilizes, that confirms the leverage purge is ending. The speculators who were forced out are gone. The market's lighter, cleaner. Third, I'm monitoring how price reacts to attempted breakdowns. Does it accept lower prices or reject them? Does it slice through support or bounce hard? Acceptance versus rejection tells you who's in control. Based on my analysis, this crash was mechanical, not emotional. It was leverage-driven, not fundamentally driven. The underlying drivers of silver demand didn't vanish overnight. Industrial applications are still there. Monetary concerns are still there. Supply constraints are still there. What happened was a technical event, overwhelming those fundamentals temporarily. That's crucial to understand. If this was structural, if demand had genuinely collapsed, We'd see different signals. We'd see sustained selling on rising volume. We'd see industrial buyers stepping back. We'd see the narrative shift permanently. I'm not seeing that yet. If history rhymes, and it often does, the session ahead may tell you whether this was the unwind or the foundation. If silver can stabilize here, if volume dries up, if the market stops making new lows, you're likely looking at exhaustion. The flush happened, the weak hands are out, what comes next takes time to develop. But the crisis phase ends. If we see continued breakdown on rising participation, then yeah, this might have further to go. Stay flexible. Let the market tell you. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said against your own analysis. Don't take my word or anyone else's as gospel. Markets demand independent thinking. If you made it this far, you're the type of person who wants to understand, not just react. That mentality will serve you well. The traders who survive aren't the ones who predict perfectly. They're the ones who observe carefully and adapt quickly. You're building that skill right now. If this breakdown helped you see what's really happening beneath the surface, share it with someone else who's trying to make sense of this chaos. Subscribe if you want more analysis that cuts through the noise, and drop your thoughts in the comments. I read them. I learn from them. We're all trying to navigate this together. Stay sharp out there. Think critically, verify what you're seeing, and make decisions your future self will respect.